Welcome back to Builder Momentum. Here we're all about building smart, passive, set it and forget it portfolios by stacking different types of trend capture, whether that's price trends, volatility, or macro trends. Today, I'm going to be talking about a unique macro and climate trend asset that operates completely outside the normal financial system. It's called catastrophe bonds or cat bonds. And man, do those cat bonds purr. If you want an asset that historically ignores stock market crashes, corporate earnings, and pays a high floating yield, you need to understand cat bonds. But before we begin, brief disclaimer, I am not yet a financial advisor. This video is for educational purposes only, and of course, always do your own research before making any investment decisions. So, the global financial system has historically operated on a dichotomy between the capital markets, which allocate funding and absorb economic risks, and the insurance industry, which mutualizes and absorbs idiosyncratic physical risks. So you've got equity linked securities and you've got insurance linked securities. However, the convergence of these two spheres has fundamentally altered the landscape of risk transfer. Catastrophe bonds are specialized insurance linked securities that securitize catastrophic tail risks and transfer them from insurers, reinsurers, sovereign governments, and large corporations directly to the broader capital markets. So, in plain English, that means the big insurance companies, they need a little bit of help, so they allow common retail investors like you and me to contribute our money to help boost the pot for payouts for catastrophic disasters and whatnot. Catastrophe bonds were conceptualized back in the 1990s after Hurricane Andrew caused an existential capacity crisis and severe capital depletion in the traditional reinsurance industry. So, fast forward to the end of 2025, and the outstanding catastrophe bond market achieved historic scale, reaching a record $61.3 billion. You might wonder, if I buy a cat bond, what happens if the insurance company goes bankrupt? The architectural framework of a catastrophe bond is meticulously engineered to isolate the transferred insurance risk from the corporate credit risk of the sponsoring entity. Let's break that down. When a transaction is officially launched, a bankruptcy remote special purpose vehicle, or SPV, is created. The principal collected from investors like you and me is absolutely not handed over to the sponsor to fund their general corporate operations. Instead, it's deposited into a legally segregated, tightly governed collateral trust account managed exclusively by the special purpose vehicle, or SPV. So, modern catastrophe bond structures almost universally mandate that this collateral be invested in U.S. Treasury money market funds, TMMFs for short, short term U.S. Treasury bills, or structured floating rate notes issued by highly rated supranational entities. So, the money that is forked over to help these insurers and fortify them against a worst case scenario is then invested into traditional very low risk bonds. So you're getting the interest from that low risk bond investment plus the premiums, well, a share of the premiums that are collected from the entities that pay these insurers to back them up against natural disasters. The strict reliance on Treasury notes achieves the absolute elimination of corporate credit risk, and it guarantees that the collateral is practically risk-free and instantly liquid if an insurance payout is required. If a qualifying catastrophic event definitively breaches the specific mathematical and geographical thresholds defined in the bond's prospectus, then the SPV will liquidate the required amount of Treasury collateral to reimburse the sponsor, causing a partial or total loss of principal for the investor. Conversely, if the bond reaches maturity with no triggering event, the entirety of the Treasury collateral is liquidated and 100% of the principal is safely returned to the investors. So that's a lot. but I'm going to try and break it down a little bit more simply about what it means on the investment side. So, the total return for catastrophe bond investors is a composite metric derived from two independent, structurally unlinked revenue streams. First, you've got the collateral return. That's what's coming to us from the US Treasury notes or supranational money market funds held within the SPV. It's a risk free yield that closely and rapidly tracks central bank policy rates. Now, on top of that, you've got the insurance risk spread. This represents the actual risk premium paid by the sponsor to the SPV in exchange for the provision of the reinsurance capacity. So you get paid this premium to have your money sitting there in a rainy day fund to, well, a literal rainy day fund to help out these insurers. This bipartite yield equation transforms the asset into a high yield, inflation resistant investment. So, in conventional fixed income markets, traditional fixed rate bonds suffer devastating capital losses when inflation rises and central banks aggressively hike interest rates. Well, cat bonds entirely bypass this structural vulnerability because the collateral is continuously reinvested in short term treasuries. The base rate floats in tandem with the broader economy, automatically adjusting upward during inflation. So, following major industry loss events like Hurricane Ian in late 2022, traditional reinsurance capital contracted, creating a hard market. Spreads ballooned massively, and by early 2023, average risk spread hit extreme highs of approximately 10%, which combined with roughly 5% collateral yields resulted in total market coupons frequently exceeding 14% to 15%, which was incredibly high. Even as the market normalized by late 2025, total yields to maturity still stood at a highly attractive 8.8% to 10.86%. So these bonds are giving yields that are far in excess of what you might expect from, just mid-term or long-term US Treasuries, which is why I find catastrophe bonds to be highly attractive because you're not only getting that short-term treasury yield, you're also getting the insurance premium on top of it. Now, how do you lose money with catastrophe bonds? The exact legally binding contractual parameters that dictate when a sponsor, the insurance company, or government is permitted to claim the treasury collateral are known as triggers. So there's indemnity triggers, which account for well over 60% of the market. This structure only triggers the bond if the sponsor's actual verified insurance claims exceed a predefined financial threshold. So while it acts as a perfect hedge for the sponsor, physically adjusting and verifying claims takes considerable time, meaning these bonds suffer from severely protracted payout delays. There's also industry loss triggers. These index the trigger to the aggregate insured losses experienced by the entire industry from a single event, certified by a third party agency like Property Claim Services or PCS. Then there's parametric triggers. These bypass insurance claims entirely, linking the payout directly to objective physical characteristics such as the sustained wind speeds of a hurricane or the magnitude of an earthquake. Because the trigger relies solely on physical data, payouts can be determined and settled almost immediately, making them vital for sovereign disaster resilience. And then there's also modeled loss triggers, which rely on proprietary catastrophe algorithms to calculate simulated losses. This structure has largely fallen out of favor due to intense model risk, however. So you also need to watch out for what's called extension risk with catastrophe bonds. If a major disaster occurs close to the bond's maturity date, the sponsor holds the unilateral right to extend the maturity, effectively freezing the treasury collateral and trapping the investor's capital while complex claims continue to develop. Now, all of that is a lot to absorb, and I'm going to put copious references in the video description so you can go and read up on catastrophe bonds yourself because they are quite complicated instruments. But what's not complicated is their actual performance. When integrating cat bonds into modern portfolio theory, the historical data is phenomenal. The Swiss Re Global Cat Bond Index, which is kind of like the S&P 500 for cat bonds, has realized an impressive annualized return of 7.2% since its inception in January of 2002, with a remarkably low historical maximum drawdown of just negative 9%. This generates a 20-year Sharpe ratio of 1.01. That substantially outperforms the US Corporate High Yield Index, which had a Sharpe ratio of 0.6. During the 2008 global financial crisis, when global equities collapsed by roughly 37%, catastrophe bonds delivered a positive 2.5% return. It's pretty impressive. Historically, the market for cat bonds was heavily restricted. In the United States, almost all catastrophe bonds are issued under SEC Rule 144A, which legally barred direct retail participation and restricted sales to qualified institutional buyers or QIBs holding a minimum of $100 million. However, 2025 brought the ETF revolution, democratizing access. Funds like the Brookmont Catastrophic Bond ETF, and the ticker for that is ILS, now allow everyday retail investors like you and I to purchase shares of a highly sophisticated cat bond portfolio with the exact same ease as buying a standard S&P 500 index fund. But understand the risks. Wrapping highly illiquid 144A securities into an ETF that promises daily liquidity creates a severe potential liquidity mismatch. If a catastrophic event triggers a panic sell-off, the fund manager may be forced to liquidate restricted bonds into a distressed secondary market, significantly widening bid-ask spreads. I don't worry about this so much because I buy and hold. I'm not going to be day trading catastrophe bonds. These are things that I'm holding in my retirement account for, well, decades. And if you have Charles Schwab, then you can also access mutual funds for cat bonds like CBYYX, which is the Pioneer Cat Bond Mutual Fund. And that has a lot fewer risks than ILS. But if you're with Fidelity or another broker, ILS is probably going to be your main vehicle for accessing catastrophe bonds for the time being. And I'll do a follow-up video that goes more into the ILS ETF because I think it's pretty nifty. To conclude, cat bonds remain an indispensable, mathematically distinct asset class, uniquely capable of generating high yields and providing severe crisis alpha by capturing the pure risk of the natural world instead of financial markets. So I hope that you've enjoyed this video, and I will catch you next time on Miller Momentum. Let's keep rolling, y'all, and feel free to shoot questions, and don't forget to like and subscribe. I'm easing back into video production after my recent surgery, so hopefully the quality of these videos will continue to increase as the quality of my health does. I will catch you all later. Bye.